Hi everyone, welcome to Lesson 1 of Chapter 3, Planning Tax Strategy. In this video, we will explain why taxes are important for your personal financial planning and how they affect various aspects of your financial situation and goals. By the end of this video, you will be able to understand the role and purpose of taxes in society and in your personal finances. Identify the main factors that influence your tax liability and your tax efficiency, and plan your tax strategy effectively and optimize your financial position and progress. So what are taxes and why do we pay them? Taxes are compulsory payments that individuals and businesses make to the government. Taxes are used to fund public services and goods such as education, healthcare, infrastructure, and defense. These are things that benefit everyone in society and that we cannot provide for ourselves individually. Taxes also help the government achieve certain social and economic objectives, such as reducing inequality, promoting growth, and protecting the environment. But taxes are not only important for society as a whole, they are also important for your personal financial planning as they influence your income, expenses, savings, investments, and liabilities. Therefore, it is important to understand the basic concepts of personal taxation and plan your tax strategy accordingly. Let's look at some of the ways that taxes might affect your personal finances. First, taxes reduce your disposable income. Disposable income is the amount of money that you have left after paying taxes. Consequently, you will have less money to spend on your needs and wants or to save for your future goals. Second, taxes affect your cash flow. Cash flow is the difference between your income and expenses. Taxes affect your cash flow as they increase your expenses and reduce your income. This means you have less money to manage your budget, pay off your debts, or invest in assets. Therefore, you need to monitor your cash flow regularly and control your spending and saving habits. Third, taxes influence your investment returns. Investment returns are the profits or losses that you earn from your investments. Taxes influence your investment returns as they reduce your profits or increase your losses. This means you have less money to grow your wealth or achieve your financial objectives. Therefore, you need to choose your investments carefully and optimize your tax efficiency. Tax planning can reduce or increase your tax liability depending on your understanding about tax and making financial decisions. Tax planning involves understanding the tax laws and utilizing legal strategies to minimize your tax liability. Effective tax planning can help you reduce the amount of taxes you owe, ensuring that you don't pay more than necessary. Hi, in this lesson, we will explain what tax deductions are. What are the benefits of claiming them, and what are the rules and requirements for claiming them in Malaysia? By the end of this lesson, you will be able to define tax deductions and identify their main types. So what are tax deductions and why are they important? Tax deductions are expenses that you can subtract from your taxable income to reduce your tax liability. Tax deductions can be categorized into 4 tax reliefs, tax exemptions, tax donations, and tax rebates. Tax exemptions are specific categories of income that the government has determined should not be taxed. These exemptions are provided for income streams that are seen as advantageous to the broader society or the economy. By carefully planning and claiming these exemptions, individuals can greatly improve their financial health. Let's explore some of the key personal tax exemption measures available in Malaysia. Firstly, we have dividends from Malaysian companies or cooperatives. When you own shares in a company or a cooperative, you receive payments known as dividends. In Malaysia, these dividends are exempt from tax. This means that the dividends you receive from Malaysian companies or cooperatives do not need to be included in your taxable income, nor do you have to pay tax on them. Lastly, gifts from relatives or employers fall under tax-exempt income as well. These are monetary gifts or assets that you receive without any obligation to give something in return. In Malaysia, such gifts from your relatives or employers are not taxable. This means you are not required to pay tax on these gifts, and they should not be included in your taxable income. It's important to note that these exemptions are subject to change based on the prevailing tax laws and regulations. Therefore, it's advisable to consult with a tax professional or refer to the latest guidelines from the Malaysian Inland Revenue Board for the most current information. Apart from tax exemptions, we're also eligible for tax reliefs. The tax reliefs are essential tools designed to reduce the taxable income of individuals, which in turn lowers the amount of tax owed. These reliefs can be claimed for a diverse range of expenditures and contributions encompassing education and medical expenses, lifestyle purchases, and retirement savings. By strategically planning and claiming these reliefs, individuals can significantly enhance their financial well-being. In Malaysia, there are several key personal tax relief measures that citizens should be aware of. Firstly, there is a relief of 9,000 ringgit available for an individual in respect of themselves and their dependent relatives. This relief is granted automatically, meaning that if you have dependents such as children or elderly parents, you can claim this relief to reduce your taxable income. So what is taxable income and why is it important? Taxable income is the amount of income that is subject to tax by the government. Taxable income can come from various sources such as employment, self-employment, investment, or other income. Taxable income is significant because it determines how much tax you must pay and what deductions or exemptions you can claim. Therefore, it is essential to understand the basic concepts of taxable income and the scope of taxation. Let's look at some of the sources of taxable income and how they are taxed. First, employment income. This is the income you earn from working as an employee for an employer, such as salary, wages, bonuses, commissions, tips, allowances, or benefits. Employment income is taxed at progressive rates, which means the higher your income, the higher the tax rate. You can claim deductions for certain expenses related to your employment, such as travel, medical or education expenses. Secondly, self-employment income. This is the income that you earn from running your own business or working as a freelancer, such as profits, fees, charges, or royalties. Self-employment income is taxed at a flat rate of 15% for resident individuals and 30% for non-resident individuals. You can claim deductions for certain expenses related to your business or freelance work, such as rent, utilities, or advertising expenses. Thirdly, investment income. This is the income that you earn from investing in assets such as stocks, bonds, real estate, properties, or businesses, such as dividends, interest, rent, or capital gains. In Malaysia, there are two levels of federal and state. The federal government imposes taxes on income, goods and services, and customs duties. The state governments impose taxes on land, property, and entertainment. The scope of taxation affects how much tax you have to pay and what deductions or exemptions you can claim. Generally, residents are taxed on their worldwide income, which means they have to pay tax on their income from both Malaysia and foreign sources. However, they can also claim deductions or exemptions for certain expenses or incomes related to their employment, self-employment, or investments. The scope of taxation is the range of income sources that are subject to tax by the government. The scope of taxation can vary depending on different factors such as your resident status and your tax jurisdiction. Your resident status as the status that determines whether you are a resident or a non-resident for tax purposes. Hi everyone, welcome back to our final lesson for Chapter 3, where we are going to discuss some common tax offenses and how to avoid them. Tax offenses are violations of the tax laws and regulations in Malaysia that can result in serious penalties and consequences. Let's take a look at some examples of tax offenses and how to prevent them. The first tax offense is failure to register with the IRBM as the Inland Revenue Board of Malaysia, the authority that administers and collects taxes in Malaysia. If you have any income that is subject to tax in Malaysia, you need to register with the IRBM as a taxpayer within the stipulated time frame. If you fail to do so, you may face a fine of up to 20,000 ringgit or imprisonment for up to 6 months or both. The second tax offense is failure to file tax returns. Tax returns are documents that you need to submit to the IRBM every year to report your income and tax liability. You need to file your tax returns by the due date, which is usually the 30 April for individuals and the 30 June for companies. If you fail to file your tax returns by the due date or not file them at all, you may face a fine of up to 20,000 ringgit or imprisonment for up to 6 months or both, plus an additional penalty of 200% of the amount of tax undercharged. The third tax offense is failure to pay taxes. Taxes are the amount of money that you need to pay to the IRBM based on your income and tax rate. You need to pay your taxes by the due date, which is usually the same as the due date for filing your tax returns. If you fail to pay your taxes by the due date or not pay them at all, you may face a fine of up to 20,000 ringgit or imprisonment for up to 6 months or both, plus an additional penalty of 10% of the amount of tax unpaid for every 30 days of default. With that, we have come to the end of the Chapter 3. As you move forward, remember that effective tax planning is an ongoing process. It requires continuous learning and adaptation to changes in tax laws and personal circumstances. By applying the concepts and strategies we've discussed, you'll be well equipped to optimize your financial decisions and achieve your financial goals. Thank you for your dedication and engagement in this chapter. Let's continue to build on this foundation as we explore further topics in personal financial planning.